I want to talk a little bit about fund investing and specifically the fallacy of investing in a fund is a blind pool, because it is no such thing. And that's the one thing I hear most often from our investors and from prospective investors when we talk about fund investing. I always hear, no, Max, just send me a deal. Let me know when you have a deal. I want to go direct into a deal. It couldn't be further from the truth that you're investing into a blind pool. People talk about, I don't want to invest in a blind pool. It's a blind pool fund. I don't know what I'm investing in. That's not the case. I'll explain why. It's very important for an investor to look at what a sponsor is doing with their fund. You have to read the documents. You have to understand the concept of the fund. If a fund is cross-asset class, all asset classes, office, hotel, retail, multifamily, and across all 50 states, yes, it's truly a blind pool fund. And there are companies that are capable of doing that well, like Blackstone. For the rest of us who aren't Blackstone, they should have some sort of a concentration, some sort of a specialty. Our expertise is value-add multifamily. Therefore, our fund is a value-add multifamily fund. We don't buy office, we don't buy retail, we buy value-add multifamily on the West Coast, which is what we do. This is not a vehicle for us to experiment in new asset classes and new geographies with our investors' capital. This is a vehicle for us to more efficiently execute, or any manager for that matter, on what they do best. So our fund is a value-add multifamily fund. We do some ground-up development as well, but our fund is not allowed to invest into any ground-up development because we want to keep our fund as narrow as possible, as low risk as possible, and as simple as possible for our investors to understand. We have been in the business of value-add multifamily for 15 years. We've done some other asset classes coming out of the downturn and in the downturn, but those were very different times. We have done 45 plus projects. We currently have 20 plus in portfolio. It's all value-add multifamily in San Diego, LA, the Bay Area, Portland, Oregon. So our strategy is effectively what we've done is we've standardized it to where it's a conveyor belt of real estate. We buy an older apartment building in one of the aforementioned markets, we renovate it, we increase the rents, and we either sell it or we refinance it and hold it. That's the first thing that any investor should be looking at when investing into a fund. What is the strategy and how does that relate to the sponsor's day-to-day strategy? Other reasons to invest into a fund versus deal by deal is the sponsor's promote is crossed. So if we have an investor come into, let's say, 5 of our deals, if one of those deals goes bad, it no way affects our promote on each of those 4 deals. Whereas if that investor invests into a fund and one of our deals goes bad, it's all crossed up. So our bad deal affects how much of a promote we make on the 4 good deals. And that's a very, very important part of a fund to understand. A lot of real estate sponsors, for that single reason, do not form funds, and they continue to go deal by deal by deal after 25 plus years of real estate experience because they don't want to cross up their promote. So we're very comfortable forming a fund because we're not worried about a deal going bad and blowing up our promote. We're very risk averse. We take very calculated risk. If a deal does go bad, we don't think that it will be so horrible where we'll be working for free for the next 5 to 7 years and it blowing up the whole fund or blowing up our promote structure. So we feel that it's very investor friendly and we're comfortable with those terms, and that's why we formed a fund. A few other things to note is that it's geographically restricted. We're in San Diego, LA, Bay Area, Portland, Oregon. We're also looking at Seattle, Denver, and Salt Lake. So we're strictly restricted to those geographies. One other thing to note, when any investor should be looking at and assessing what the risk is in any opportunity is how much debt is there. And our fund docs specifically restrict us to how much debt we could put on an asset. Our restriction is 75% of cost, but we typically don't lever more than about 70%. The few assets that we currently do have in Fund 2 right now are not levered higher than 70% of cost.